Hello, welcome to another edition of Nucleus Investment Insights. Apologies for the late start. We had a unscheduled fire, evacuation. So yes, running a little bit late. But I think the main thing, so what we want to talk about today was economics of data centers. And so the key to this for me is we've got this AI boom going on at the moment. And the AI boom is dominated by the biggest companies that are involved in, and they're all rolling out these massive data centers. There's trillions of dollars, literally trillions of dollars being spent on this. And so what I really wanted to get into is just some of the big picture numbers that we're talking about in terms of data centers, because I think given it's the most important theme in the market, sort of driving it higher, it is important to understand what are the underlying economics and where the pressure points are, and which are the sectors where there's a scarcity issue in terms of it being, look, prices are really high because things are scarce, versus sectors where prices are high because there's something new that's being done and there's genuine, or at least there seems to be longer lasting value to be coming from this. So yes, so I wanted to dig into that today and talk about the investment implications of it. Just a reminder that things you hear today are it's general advice in nature. None of this is personal advice. If you are looking for personal advice, we can hook you up there. There's some information in the show notes. But yeah, everything else you're hearing today is general in nature. So what I really want to talk about, so a bunch of different things. We're going to run through why we've seen so some of the history and what the real difference is in the data centers that are being built today versus the data centers that were being built 10 years ago. Some of the cost anatomies of it, of where are the costs? What are the costs that are being driven up because they're just a small cost as part of this overall sort of valuable infrastructure, and so there just happens to be shortages. Some of the power things that is going on, because there's certainly some big issues in terms of what's happening with the power, and then talking about the economics of these and how do you make money. So how the company's actually doing it, and then who's actually buying, because this is part about, I was speaking about in the last few weeks about saying we want to make sure that we're not just this self-perpetuating thing where you've got companies raising money to then go give the money to other companies who then plow it back into the first companies, and there's a little bit of that going on, which is of some concern. But it's worth sort of knowing who the players are, and just sort of so we can track this over time. And when that ratio becomes too high of the sort of self-perpetuating, you've got high prices because other companies were high prices because it's all sorts of self-referential. That's where the biggest concerns will come around that. So that's that. So I thought there's a couple of charts I just want to run through quickly as well that I've brought up in prior podcasts, but I just sort of thought it was well worth just going back through these, just the thought process behind what's going on here, and sort of, I guess reevaluating where we're sitting. So I've spoken about these booms going on, and there's this growth curve that's expected over the longer term, where you get this sort of technology trigger, and then you get this huge increase, and they call this the peak of inflated expectations, where everyone thinks everything's going to be fantastic, and you get these, whether it's a railroad boom or an internet boom or whatever it is that's going to drive higher housing booms. That we're into this new paradigm. And then something happens, and you fall down. Actually, housing was probably a bad example. Sorry, I'm talking about technological booms. And then you go into this trough of disillusionment, where everyone's like, oh, we thought railroads were going to be fantastic, and now they're all being ripped up, and we built all these railroads, and they're not making enough return, or we've built all this internet stuff, and it's not making great return. And then you actually get genuine pickup, and you end up into this slope of enlightenment, it's called, and plateau of productivity, which may actually be I think in some cases you often end up higher than the peak. It's just a question about how long it takes to get there, and so it's this idea that when you've got this grain of truth, that you're going to go through this boom. And the question now is, are we at the peak of inflated expectations for AI? I'm going to argue the case is no, but it's worth keeping in mind that we will go through this cycle at some point, and maybe we're already close to the peak, or maybe we're still just on the way up. And so that's at least keeping that in mind as you're considering what's happening within this. I've got this. I think I'm not 100% sure of the pronunciation. Ouroboros is this idea of the snake that eats itself, and just to take the names off it, there's sort of 3 companies that have been in the news in the last few weeks, and basically one company, let's just call it company number 1, is reporting a $400 billion increase in their booked revenue from another company 2. Now, company 2 is a loss-making company. It only makes $10 billion in sales per quarter, let alone actually any profits. It's actually a non-profit company. It's unclear whether it's legitimate for this company to raise money, and the first company, go back to the first company, the one that reported that $400 billion increase because of this booked revenue from the second company. Well, it's actually going to go into debt to build the assets to service that second company that hasn't actually got the money yet to pay for what it's ordering. Then you've got the third company. Company 3 steps in, and it looks like it's going to give $100 billion to the second company, and in equity or debt or a mixture of both. The second company is going to give that money back to the first company to go and build the stuff. And the first company is going to use that $100 billion to go and give it back to the third company because it needs to buy their products. And so, that type of thing is where you start getting concerns, I suppose, in terms of that. I do think there is some genuine value behind this, but that is exactly the type of transaction that when this whole thing, when something falls apart, that transaction goes to zero very, very quickly. All of a sudden, no one can afford it, and there's that's the unwind of a boom, and part of that, what's driven you to those heights, very quickly comes back the other way. So keeping that in mind, that we're in this. If we're still in the start of the boom, then this is fine. That funding maybe the couple of years down the track will be a lot harder, but it gives these companies time to grow and actually grow into the revenues they're expecting and all these types of things like that. So if that's the case, then we're fine. But if it's not, then then look out. If you're of the view that we're pretty close to the top of it already, then there's there's certainly some warning signs around in terms of those types of transactions. The other one I wanted to do. Now, I put the first 2 levels of this up in the past, and it was just that interesting factor that, pre-1980s, technology pretty much flowed in one direction. You generally have these government or military type of applications, including the internet and other things like that. They would then sort of seep their way into business, and then eventually they end up in the hands of consumers. Computers are a similar type of thing, used by governments and militaries, and then into businesses, and then finally into the personal computers. Post 2000s, that technology really flipped around, and you saw a lot of technology that really started with consumers and eventually worked its way back into businesses, and then finally into governments and military. And whether that's sort of a lot of that sort of communications type things, smartphones. A lot of social media and contact and all these types of things like WhatsApp and stuff like that. A lot of these sort of started in consumers and then gradually worked their way back into business and governments. AI is I don't know. You could throw these a bit everywhere. I think you could have a story for each direction and depending upon where you're looking. I guess the main thing I wanted to highlight is there's not as many consumer applications for this yet. And so it's sort of this interesting part where for the last 15, 20 years, you've had a pretty clear view about what works in the consumer, and then will it work in these other, that's sort of like, that gets you some of it, and people can see it in action, and then you can sort of imagine how it's going to then flow back into businesses and governments and militaries and things like that in terms of how it works. The AIs, there's certainly some government stuff that's they're trying to be there. I think it's mostly businesses though that are really leading this, and so the consumer applications. It's I guess where I'm trying to get to here is it's a lot harder to work out where this is going. So it is a different technology process than what we've seen recently. And then the other thing I just want to highlight as well, in terms of, I'm going to talk a lot about costs of data centers and cost to build and everything like that, but things are still changing really, really quickly. So a useful way to do this, to benchmark is by just talking about different models. And so there's a DeepSeek model out there. I've used, well, sorry, the data source I've used this is 670B if you're for those playing along at home. But basically, in July this year, the cost to train this model was about $4.5 million. So you get the version, you train it all up on whatever data you're looking for and whatever parameters you're going to overweight or underweight, and that's cost you $4.5 million. By December of this year, that's probably looking like going to be $2.5 million. So not quite halved, but pretty damn close to it. And that's in less than 6 months in terms of the costs that are happening there. Now, that's So we're going to talk about costs, but keep in mind, this is the best we can do at the coalface. But you really need to be watching what's going on in this, because today's winner could very easily be the 10th place company in a year's time, if they're not keeping up and they're not sort of going forward with all these. Right, so that's that. The other one I just want to highlight as well, and this is sort of this whole part. It was a chart I put up, came from NVIDIA, but it's just talking about to me, it highlights quite clearly the difference between the old data center and the new data center. And so this is where the old data center basically had independent computers largely. They had an Ethernet cable, so basically your typical network cable that would connect them all up. And the idea was you could do these, you'd send stuff back and forth, and you're surfing an internet website and it pulls from one server, and then you jump to a different site and it pulls from a different server, or I'm accessing a database and I'm accessing a website, and then the computers will be talking to each other, but they didn't need this massive bandwidth in terms of how they talk to each other. So, Ethernet was plenty fast enough for them, and everything could be pretty independent. And it didn't really matter. It was nice if I had my database sitting next to my next to my web server, but, if it didn't matter that much if they were, maybe even in different data centers. That's different with AI. The key thing with AI is, and a lot of the training that's being done is, you just need to load these massive data sets into memory and then run all these calculations and then put it down. And so if you're trying to, and the data sets are so big that they can't sit in the memory of one computer, you need to be able to use multiple computers and hundreds or thousands of sort of network together. And so it just, the speed and the cost and everything like that was very different. So the first column in this is just sort of showing you your bandwidths and how far you can run these in terms of Ethernet and what your power efficiencies are and your cost efficiencies. And it's just that point about you do that, and then you start looking at some of these NVIDIA technologies where you're first of all, you're using these GPUs and you're starting to stack them together so that you can actually, they can all talk to each other. And then you've got systems where you're putting your memory actually, rather than sending it via the motherboard, you're actually integrating it in with the GPUs and all these other things like that. So technological advancements that just mean that you need everything really, really close. They're way more power efficient, but and you don't have to pass data around anywhere near as much, but it's just this completely different model about how it happens. And so it goes from being these independent computers sort of sitting in these data centers to these huge networked factors. And so that's where NVIDIA, has really sort of shone in terms of being able to create these, not just the hardware behind it, but really the systems behind that whole hardware in terms of how you network these together, and the sort of the operating system, so to speak, for data centers. So it's this idea that what they're doing is generating this ecosystem that everyone's using then to go and build new things, and that's really what's driving a lot of that value within it. Okay, so we've got this idea, completely different data centers to what we had before. Some of the things we will jump into it in a minute. One is a lot more dense in terms of the compute that's being put on, and that then means that you need a lot more power within sort of smaller elements of that. And the other factor on NVIDIA is, that they're sort of effectively saying this is your new design for data centers, and in a way they're sort of trying to become the operating system for data centers. Okay, so if we start looking at, say, looking at we want to set ourselves up with one of these data centers, and so the idea is that the most important thing we're buying is these servers within it. Now, if you're going to be buying some of the older chips, some of the H100s, it's probably $200,000 a server. The newer ones, the GB200s that have recently been released, are more like $3 million per server. And so that's what you've got this upfront cost. You got to pay for this server to put it in there. Then you get this all the extra costs that go along with that. There's the networking cost and storage and software licenses and installation and all these other things like that. So if we're talking about one of these $3 million servers, you're probably talking about another 700,000 or so. If you're and sorry, these numbers, the big picture numbers I'm talking about now are for hyperscalers. So these really big Google's, AWS, AWS, which is Amazon, Microsoft, those types of people who can access economies of scale, and they're often running the entire data center themselves, and they get all these these benefits from not having to pay other people to do a lot of this stuff. So you've got that. So they're sort of coming in. I'm sorry, and they've also got quite close relationships with all the providers. So if you're talking about getting chips from NVIDIA, that they are they're going to get better price to Microsoft, who's buying tens of thousands of these things versus somebody who's buying 3 or 4 of them. Okay, so you've got those hyperscalers there. Then you've got these, some are calling sort of the neo cloud giants, who people like CoreWeave and a few others that are sort of popping up that are doing. They're not trying to do everything. They're just trying to do sort of a lot of the sort of. They're often they won't have the servers themselves or the data. Sorry, they won't have the data centers themselves. They're not their data centers. They're somebody else's data centers. They're just renting racks out of it, but they're renting the entire sort of bare metal type racks. And they're basically saying, okay, you give us the power and the connections, and then we'll run everything that sits in the rack. And so they can sort of they're probably looking at costs maybe 10% higher again, just because they're still quite big, but they're they're still. Yeah, they're quite big, but they've got problems in terms of accessing this stuff. They don't have the same economies of scale. And then you've got another bunch of these. There's a whole bunch of sort of emerging, quite small ones. And there's a mass amount of companies that are all in that space who are all effectively, renting racks and selling it and selling their servers out to people. And in a way, there's this real. The economics. There's an economics of scarcity at one end where it's just like here's some random person who happened to have access to a bunch of these server racks, and so because they've got access to them and they'd pre-booked it for a few years or whatever it is, or bought it for whatever time, now they can throw and they've managed to buy themselves some NVIDIA servers, so now they can throw them in there and run just a real basic service, but charge a lot for it because everyone just really wants to run these. And in a few years' time, once the scarcity goes away, do they have a business model? Probably not. So there's a few of those guys out there as well. And so what that means is you sort of add up all these and you get these capital costs. Let me just pop up a quick slide of those. You get these capital costs where, depending upon what you're running, but you're sort of talking about maybe $2 for the latest sort of servers. For some of the earlier ones, maybe $1 per hour per GPU. That's your sort of capital cost of saying, okay, I needed to buy this thing. What did it cost me in terms of that? Then you've got the running costs of it. So we've got those costs that go into it. Sorry, let me bring up this next. We've got the running costs now. Electricity, co-location costs. Remote support engineers and all these other types of internet connections and all that type of stuff like that go through. They're probably adding about another 50 cents in terms of these latest servers in terms of your costs there. That's your sort of ongoing part, and that sort of ends up with getting to these capital costs per hour of sort of. Sorry, if you add up your total running costs in terms of that, you're talking sort of $2 or $3 an hour to run these the latest chips. Now that's your running cost. Now you can sell these off. Now these go depending upon who you're selling it to. You can sort of get $6 an hour or more, maybe $10, $15 an hour for some of the more spot instances. And so there is this business model out there which is saying, okay, it's very profitable to buy these things, rent it out. You're making massive returns on your equipment. There's lots of scarcity. Lots of people want to do this. It's actually remarkable the number of the people who are doing it. So there's some of these customers are often some of the other hyperscalers. So some of the smaller ones who are actually selling this, it might be that Google's already booked out all its stuff, and somebody's got something they're running and they really need it. It's urgent, and so they're happy to pay some of the higher costs. And so despite Google having all this stuff themselves, they're actually running it on other people's servers or Amazon or Nvidia even runs a lot of stuff on some of these other people's. And so there is a reasonable amount of circularity into this in terms of who's actually running it. But the ballpark, the business model is quite attractive, and it's worth sort of thinking about this as sort of similar to say cars or transport. Is you say, okay, well, if I don't use very much, once, twice a week, I'm probably going to get a taxi. If I'm going to use it once or twice a month, but I might have quite concentrated, I might be doing a whole bunch of stuff, then maybe I'm going to rent a car from, I've got a hire car place and I'll rent a car for a day or 2 days or whatever it is. And then you're getting back to the stage of, okay, now I'm using it enough. I want to own it myself. Do I lease it so that I save myself some capital costs and I've just got this ongoing running costs, or do I buy a car outright and then depreciate it and do all that type of stuff like that? It's sort of similar to how you're thinking about these. And then similar for companies, Google's got a bunch of its own ones it owns, but there's this overflow where it's like, well, I don't really want to own these all the time. Every now and again, if I need an overflow, I'll just rent it from somebody else. I'll go to a car company and rent it. It's that type of idea behind that whole process. So, okay, so we've got this idea that, and so, sorry, some of the things I wanted to dig into that were interesting. First of all, electricity is really low as a percentage cost of that running costs. So, it's really important. I'm going to get to the power in a minute. If you don't have power, you can't run this, and that there is this problem of can you get power? But the overall cost of the electricity is just not high in terms of the overall, in terms of what the spend is. And so it makes them not particularly price sensitive. And it's sort of interesting in this idea that you can, that the idea that these companies are going to outcompete other people. You need to run your house, or you need to run, or you've got factories out there that are talking about load shedding and doing other things like that, where electricity might be this really important input cost, and whether they do it or not, depends upon the price. Whereas for a lot of these, is you're like, well, if I'm paying $6 an hour for this, and the electricity cost is 10 cents, and it doubles to 20 cents, well, I'm paying $6. It's like, now it's $6.10 I'm paying. Or if it triples, it goes to $6.20. It's just like, oh, well, it's not quite a rounding error, but it's just not a significant cost overall in terms of, if the energy price has tripled on these. And it does mean that, they're just not they're not a price sensitive buyer of that. And the other thing is the amount of money that goes into that capital. Like that capital spend is sort of 80% plus of this is this capital cost. And when I'm talking about the capital cost, I'm talking about the capital cost of buying NVIDIA products and then everything else that sort of fits around that. But, the NVIDIA product is the main one that sort of fits within this. And so the idea that you're saying, well, and I think this is the big picture idea that we need to keep focusing on and coming back to is this cost of compute, who's doing it, how much they're getting. Because at the moment, you look at the NVIDIA and what they're doing, and the cost per GPU per hour or whatever unit you want to use to measure this. But it still works out to be really efficient for people who are doing it. It still works out to be, there's too much demand for a lot of this stuff in many places. And so, can NVIDIA keep doing what they're doing? Well, as long as they've got this, as long as the economics look anything like what they look at the moment, then yes. And so if we start seeing those costs per unit that you can rent these things out, plummet towards $2 or something like that, then you need to be concerned about where this is going. But at current demand is not a problem. So then we want to talk a little bit about power. Now I showed a couple of charts last week on this, and it's this idea that we've got doubling, tripling, quadrupling of data center electricity demand by 2030. There's another bunch of charts I can show as well, which is the source of energy demand over the next over the next 5 or 6 years. It looks like 50% of energy demand in Japan. Keeping in mind, Japan's got sort of a falling industrial base and a falling population as well. But 50% of all the new electricity is going to be going into data centers there, and not that far behind in the US. So heaps of that. The other thing then within the power is, and this is the important part, is I've just got a chart up from McKinsey just showing how long it takes to get things. So in 2019, you wanted a generator, 6 to 10 months, you would have had to wait. Now you basically got to wait double that. Or sorry, not quite double, maybe 50% more, 10 to 16 months. UPSs, uninterruptible power supplies, you're talking double that. Transformers, some of these are like 5-6 times greater delays than what you used to have. Power distribution units that used to take 2 or 3 months now going to take you closer to a year. So the idea is, the power has become this limiting factor for these data centers. So data centers rushing to try and build as much as they can, and just can't get their hands on the equipment. And these are the ones where you're seeing just these incredible price rises. You're seeing some great revenues made by the companies in these sectors. You're seeing lots of different scarcity pricing for things that are really just not that technologically advanced. So you need yourself a new transformer. Look, they've been around for a long, long time. We're just not making them fast enough, and people who are making them are like, well, do I build a new factory to make more of them, or actually, am I just going to kill my own demand? Am I going to flood the market and kill kill my own market if I do that? There's questions around that. But also this has been very fast, and so that they haven't had time to react. But I'm sure at some point you'll see this wave of extra supply coming on, and all of a sudden we'll have too much of these things. But I think it's well worth keeping in mind as we're thinking about these sectors, is which are the ones where there's a scarcity pricing. We need to pay attention to what's going on. We need to look at how much is being built and all that type of stuff like that. But don't get so excited. Here's a company that just tripled its revenues over the last couple of years, but it's tripled its revenues because it's selling products, very commodity-like products that are just in scarce demand, scarce supply. And so you're going to find in a few years' time that, it's tripled, but it's going to go back down to those former levels at some point, or maybe it end up higher. It might end up 30, 40% higher just because it's got bigger demand, but it's not going to stay at that sort of triple level. So they're the companies we need to be a lot more concerned about. If you want to trade them, but that you need to have a real close eye on what's happening in this Capex sector. So what is going to happen though? This is the real question within it. So I spoke a little bit about in each rack you just need way more power, and what that means is you used to set up a data center. You basically needed a power supply. So I've connected myself to the network. Often they try and get 2 connections to the network, so between different power grids and things like that. You need a UPS and you need some generators in case, and that'll keep you up. So your power's there. If you get breaks in supply, you've got this UPS to keep everything going, and then if the break in supply looks like it's going to last a while, you can fire up your own generators and keep running these data centers. Now, the problem you've got now is it's not the same. Oh, I'm building in this new data center and I need 5 times the power I used to use in the old one. The old one you could pretty much hook up to an ordinary network. Now I need to start talking to the network saying, hey, I'm gonna create this new data center that's got this massive amount of power that's needed. Can I plug in and start pulling it? And all of a sudden the network's like, well, just we don't know if we can supply that amount of power, and and do we have the transmission lines, and do we have the connections, and there's all these types of issues around that. So a lot of talk about people building their own power plants and co-locating, or these some firms who are out buying old nuclear power plants or aging coal plants with the idea that we're going to buy this and we're going to supply that into our data center, and that's the way we're going to get the supply that we need. It doesn't look like that's going to be the case in the long term. Like, that looks like a short-term issue about power. The issue you've got is redundancy is really important to most of these companies. And so if you're saying I'm setting up a whatever, X unit, 100 unit data center, and so therefore I'm actually going to need 150 or 200 units worth of extra power in order to have the redundancy and all these other things like that I might have needed behind that. And then you add in all these extra costs that go onto that. It actually means that the power cost ends up being nowhere near economic, because you're just paying double or more the power cost you need. So being able to say, I'm going to build a data center and then I'm going to build my own power plant next to it, and that's going to supply all the power is, I'm just going to have this power plant that's not being used all the time because it's got all this extra redundancy so that I can supply my data center. And so what probably will happen though is part of the power, and I think that's actually a most likely scenario from my perspective is, I've got my 100 unit data centers there that I want to plug into the network, and the network's like, man, I can give you 20, but I can't give you 100. And so it's like, well, I'll build myself a 90 megawatt or something next to it. I'll build my power, and I'll put batteries in and all that type of stuff like that. Or I'll build a 60 or 70 one. I'll stick all these batteries in and I'll suck all this extra power overnight when other people aren't using it, and then I'll use that to run the data center, or I'll put solar in there, or whatever it is. Gas-fired power plants in the US in particular, or hydroelectric in certain locations. But the idea is, yes, I'll actually have this power that'll allow me then to attach my thing to the network, get all the redundancy benefits and all that of the actual energy system, but not have to build all this extra redundancy yourself. So so from that power perspective, it's really about this whole speed issue now, and can you get the connections that you need, and that's sort of this a real factor that's sort of limiting all these. I probably spoke a little bit in the past as well about power efficient chips, and I think that's probably one area where I think I got it wrong. There is some significant power efficiencies coming through in terms of chips, and initially my thought was, well, that'll actually mean that that will sort of help in this whole process, and you might see that there's the chip makers might start trading off power efficiency for speed, and say, oh, well, if I can make something 10% slower but twice as power efficient, then maybe that's actually better, because it means we can build these data centers more quickly and easily, and get them all up and be not as powerful, but be change the trade-off. What's changed my mind really on that is two things. I think that'll eventually come through, but maybe it's 10, 20 years away. I think in the short term, the speed that's needed in terms of the other scarce resources that are needed means that the electricity is just not one of those factors. So if it's a choice of me building, having to build 11 data centers rather than 10, because I can build them with slightly less efficient chips, but more be better on the power. I just don't think I think when people look through it, they'd be like, no, I'd prefer to build 10 and just pay more for power. It's just not going to be worth the trade-off between that. Given power is just not such a it's just such a small factor in terms of this. So there's that. Actually, I've got a few more things I want to talk about this, but let me just jump to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. Okay. So, sorry, I know this is taking a little bit longer than I expected actually to get through this, but as I said, I think this is a key. It's a key measure we need to be worried about going forward, because if the economics stop adding up for data centers, then a lot of this AI boom goes away. Okay, so some other weird stuff goes on with data centers and power is that, first of all, data centers do have all these backups and looking at putting a lot of power in, a lot of this redundancy. And so that can actually help the grid. Like when you connect them, there's actually some benefits in terms of being able to say these data centers have got this redundancy they don't actually need at all times. And so can they load share and do things like that? Yes, I think there's definitely things for that. Probably more importantly, though, is this idea about they've got this higher willingness to pay. And so that just means that, can data centers crowd out industrial users? Can they crowd out, home users and things like that? Yeah, maybe. And so, and particularly in particular regions, that's becoming an issue within the US. So there is this part about, look, do you just build all these things in a low cost electricity environment? And the answer is yeah, if you can. You do need to get the staffing for it, and so that can be an issue. It means you're probably less likely to build this, in the middle of nowhere. But there's lots of places in the US that have got, they've got lots of gas within the US in particular is low cost, and so that's genuine. Would you move it to other countries? I think the answer there is less likely. I think there's much more likely to particularly for the US, because they've got such low power costs already. That's that's a good start. You want it to be near your staff. Like this isn't the same as if you're building a widget maker that happens to be quite energy intensive. You're much more likely to go, okay, let me move it to a country that's got lower electricity costs, and I'll just train up the staff there, and they can make these things. A lot of the manufacturing processes are a lot more simple. Whereas in this case, actually one of the bigger benefits a lot of these people have is the staff and high quality staff that can do this stuff and do it right, is much harder to get. And the other interesting thing with these data centers is versus a typical industrial user is an industrial user will tend over time to be more efficient in terms of energy usage. They might end up using more, but they will tend to be saying, if you're you're putting new light bulbs in, they're going to use less power than your old one. You're building whatever cement you're making cement or whatever it is. If you've got a more energy efficient way of doing that, you're quite likely putting that in and using less energy and getting the benefit from that. The data centers do have the issue that they will, they're definitely getting huge improvements in terms of unit costs, but the demand is so high for this that, in a way, the efficiency is actually just going to generate more demand. If these things are more efficient and now the cost of compute, the total cost of computing goes down a little bit, then the demand is so high at the moment, it seems like that's just going to drive it higher. And so, you're not going to get these power efficiency benefits. Okay, so just to put this in perspective, the power side of it, because this is sort of why I'm focused on the power is that is a limiting factor, and there is the opportunity to invest in the companies that are there. We do have a reasonable investment in some companies within our own portfolios that are quite heavily involved in this sector, and so it's worth noting, the types of levels we're talking about. So this is again from McKinsey. They're sort of talking about 3 different scenarios of 3.7 trillion to 8 trillion. So basically, well, let's call it between $4 and $8 trillion of spend on data centers, and where does that go? So if you're talking about within each of these, so let's say we're talking about the highest case there, $8 trillion spent. about 0.6 of that, so 600,000 is what they're looking at in terms of the power cost of this capex. Your IT equipment is the vast majority of that, and the vast majority of that IT equipment is going to the GPU, or there are some other alternatives out there, but at the moment the vast majority of that is going to NVIDIA, which is why we're seeing such huge prices for NVIDIA. It's this idea that, look, if they're right and there's this accelerated demand, if just big picture, if NVIDIA is sort of $4 trillion in market cap, and there's going to be $4.7 trillion of spending, or they're going to make $4 trillion in sales over the next 5 or 6 years, well, that's, and they're getting 70% margins or whatever they're getting on in terms of maybe 60, 70% margins, the whole thing, looks, that's the reason behind, you can see this, that valuation, it maybe looks cheap. And then you've got this data center infrastructure side, which is your, all the rest of the stuff that goes into that. And there's a reasonable amount you'd throw into the staffing side of a lot of this, but often that's going to be quite concentrated. The whole staffing side in it's not sort of a broad based. There's a housing boom going on, and so you 500. Say it's $500 billion they're looking at in extra staffing costs. Is it in a housing boom that's spread out to the lowest cost workers, and you've got a lot of people all benefiting from that? It's quite possible here that a lot of that money is just going to all accrue to a smaller number of specialists in the area, and so they'll do really well. But the question is, is this broad based? And it's probably not. Okay, so that's our data centers power side. I think there's a couple of other things I just wanted to touch on before we got through to it. So that's power. The big question now, I mean, the real question behind this is, is this just IT companies buying their own product from each other? So we saw that one where, I spoke about the example earlier where, Oracle's got this huge increase that comes from OpenAI that's getting funded by NVIDIA, and Oracle's buying NVIDIA's products, and you've got this whole, just a minute, where's all this money coming from? Is it just this whole big circle? And so there's no real outside consumers or not? Now, the data is really hard to get for this. And it's changing and growing so quickly that it's hard to come back to it. My best guess on what what the actual spend of people actually out there buying the compute is that at least a third of it, probably more, pretty close to half of it, call it 35 to 45% of this is the hyperscaler's own workloads. So Microsoft, Google, Amazon, and all that type of stuff, they're the ones, so not only are they building this, but they're also the ones doing these calculations for some of their own models. And so, and trying to set up their own stuff within that. And so, that's the part where it's, that's the part where what we're doing is it's coming back to that, is it the snake eating itself? Yeah, that's maybe. So a third of it, a third to a half, third to under a half, I think. Then you go, okay, well now you've got to throw on top of that again. There's probably another 20 to 30% of that is going to be all these new startups and these ones like Anthropic and OpenAI and XAI, Cohere, Mistral, all these types of ones. Plus some of these GPU cloud people who are providing services to those like CoreWeave or Lambda, who are sort of reselling process. So that gets you to somewhere, definitely gets you over 50%. Probably gets you somewhere, could be as much as 3/4, let's call it 2/3 of the market, probably somewhere between 55 and 75%. Is that those startups, and that's the part where they're going to keep going as long as you've got that, as long as you keep getting that that revenue. As long as they can keep raising money. So as long as there's an AI boom going on, these guys who don't have any money but have got these exciting plans and potential to grow, as long as they can keep raising money, then that sort of adds to this demand. Then you get sort of what I'd call more like your real economy type stuff, and I think that makes up the final sort of somewhere between 1/4 and 1/3, maybe a bit more So who's that? Financial services. So banks are probably the biggest ones within that, whether it's trading, some of their investments and insurance and things like that are out spending a lot of money on this. And I think the idea behind a lot of these is that, look, say from the banking and the trading side is saying, well, we think this can do better than a lot of the traders we're spending lots of money on anyway. So yeah, whether we're spending, and we don't want to get left behind. Basically, we don't want to. They're happy to spend more money now because they don't want to lose money in the future, and they're probably not going massively into debt or anything like that to do this. So that's one part. There's the whole insurance banking side of it where transformational to the business. So you're talking already insurers who are looking and saying, okay, there's a car accident. They can either send an assessor out and do the whole thing and check and take photos and do all the analysis, or they can do this by AI and get 98% of the answer they might have got if they had an assessor there. And so, and then try and deploy the assessors for the just a few of the cases. And so that's transformational to the business, and there's genuine spend there that I think you're going to see for some time. Healthcare, biotech, pharma is probably the next biggest one. You're probably talking 10%-ish. And that's all this whole drug discovery, imaging, biofoundation models, all that type of stuff like that. So, the idea behind this is really that there's things going on, say in imaging, which is just, AI reading whatever scans so that you don't have to have people doing. And there's genuine cost savings within that. And, your concern if you're involved in any way in that business is if you don't do it, your competitor does do it, and all of a sudden, you're out of business. And so there's money being spent in that sector. There's probably it's probably less than 10%, somewhere between 5 and 10, I think, is the whole manufacturing, robotics, vision type stuff. There's a whole bunch within that, including that cars as well, and so that whole self-driving cars. So they're out there busily using these services, and again, that's that productivity gains. That's that seems like genuine money that's behind that. Media, gaming, consumer internet, all that type of stuff like that. It's probably a similar number. And there's a government, defense, public sector. It's probably not that much. It's probably less than 5, probably 5-ish% at the moment. And potential to grow. I think there's certainly on the military side of that, there's a reasonable amount of spending going on at the moment. And I think with a couple of reasonably sized breakthroughs and the Ukraine-Russia war is I think where a lot of the stuff's being done, or certainly a lot of the epicenter of some of the research that's being done. If you see some reasonable breakthroughs in terms of what's being done on the battlefield there, I think you're going to see a big push from a lot of countries to up their spending in that space. So that's all real. But as it came back to it, I sort of feel like call it a third. I think the sort of real spending is about a third. The self-referential spending is probably 2/3 of it at the moment. Of that, these hyperscalers, the big ones, Microsoft, Google, Amazon, they're making lots of money from their existing businesses. They need to make sure they keep making money from those existing businesses. They're spending is probably relatively safe. So that's the bulk of this next one. The startup stuff is probably 20 to 30%. Is probably that startup money, which is the spend that's happening just because they're managing to raise money, and that self-referential stuff I was talking about in terms of raising to buy to go back to that. Okay, let's talk, and then I'll just one more sales message, and then let's talk about the investment universe and where we're looking in terms of that space at the moment.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing. The generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defence contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, final piece of the puzzle. Who can you invest in? So, and I'm talking again about data centers. So there's obviously a broader AI universe on there, and it can be very specific in certain areas. So I'm going to talk about more about saying we've got this capex boom going on in data centers where we can't get these things fast enough. Who can you invest in within that space, and what's your available? So firstly, there is the builders. So there's a number of companies out there that are either real estate developers, design firms, construction companies that specialize in this area, and there is. I'll talk a little bit more about these in coming weeks, but there's because that is one area we're watching relatively closely, because this is, first of all, it's your leading indicator to what's going on. When these guys start to slow up, you'll have an idea that, hey, the boom's starting to slow down. That potentially there's something there. That's the other part of it is the funding stops. So you go into one of these issues. So yeah, sorry, let me talk about this again in a different way. There's one way to look at the builders as a foreshadowing about what's happening in the sector, and that's a bit about, okay, are these guys getting new orders? Are they breaking ground? Are they doing the surveying? They're doing all the stuff they need to do in order to get that. And you say, okay, as long as that's strong and healthy, then that's a sign that the boom's going to keep going on, and it is at the moment. There's another part to go, okay, when can you use that to tell us when the boom's going to finish? And the answer is maybe when all that slows up and all that type of stuff like that, you can try and work out when the boom's going to finish. So it goes back to a more normal over this rush to get as much out as well. But the other option is similar to what you see in most other booms, is that they won't know. They'll be out there. They'll have an order from somebody to build a new data center, and then next thing you know, the company they had an order, and they'll be talking to their investors saying, "Hey, everything's fine. Yeah, it's all great." And next thing you know, they'll be reading the paper about the company that gave them the order going bankrupt and not being able to raise money anymore and all that type of stuff like that. So they're sort of helpful about the telling you the boom's going to keep on going, and maybe there might be if it's a nice gentle end to it, they might tell you that the boom's coming off. But I use the mining services companies as a great example. Is that when the mining boom finished, they were the last ones to know. They were out, vehemently telling everyone in the market everything's fine, because the third level manager they were speaking to at BHP, that's what they were saying. That's what they were being told to say. Everything's going ahead. It's all set. And meanwhile, the board's having conversations about maybe we need to shut the whole thing down and stop all this capex. And they'll read about it in the papers. Okay, so there's those guys, and we'll talk about some of the individual companies about involved in that in coming weeks. You've got these energizers, so to speak, the companies that are out there doing the energy and the cooling systems and all these types of things like that. Now, that's where we've had a reasonable amount of investment. There's a number of companies involved in that area. And so, and yes, you look through our portfolio, Schneider and ABB and, a few other ones within that is where we've sort of been picking up our exposure to those. And that's been on the services front, with that. Is that going to go, are those guys going to be able to do it forever? No, they're not. The thing is, the companies that are involved in that actually for us have got some other interesting parts in terms of also being involved in a lot of the automation and setting up new factories and stuff like that. They're also involved in the whole green sector and just changes in terms of overall changes to the electricity grid, whether you're getting more green or you're adding nuclear power or you're adding more gas, whatever it is, those guys are also involved in that. So there's the energizers that's within that. Then you get these, the technology developers and the designers. So these are your semiconductors that are actually making the chips, either making the chips or doing it. So these are your NVIDIAs, TSMC at one point, at some stage of the cycle, and Broadcoms, a whole bunch of other companies involved in that whole part of it. They are your picks and shovel. They're selling you picks and shovels. They're profitable, very profitable. You do want to know, when the whole thing's going to finish, that because they won't be able to produce as many. They're probably still going to be around, but they just won't be going at the same rate. Then you've got your operators for your the people that are actually running these data centers. So you usually your big picture ones, your Google, Amazon, a few other ones like you get ones like Equinix that'll allow. They're sort of a basically sort of like a property trust type company out buying these data centers, doing a bit of it, but a lot of it then a lot of the other stuff will be done by third parties. They'll often sell their space to others, say an Oracle or a CoreWeave or someone like that. And then you've got your AI sitting right at the end. You've got your AI architects, so the people who are actually out making the models and things like that. And so that's your open AIs and your Anthropic and all those. And they're the ones that tend to be the most loss making at the moment. Everyone else in that cycle is really making pretty reasonable profits. And it's really just a question about, trying to get a normalized figure for these. When the boom ends, where are they going to finish up? Could the boom double from where it is at the moment and these things go faster and you get more and more demand for it? Sure. Got to keep an eye on the capital markets. What's confusing as well at the moment from our perspective is a lot of this stuff is being done outside of capital markets. Outside of the listed capital markets. So whereas during the tech boom, almost all of it was being done within the listed markets, you'd certainly see there's some element of private equity and stuff like that, but really not that much. The venture capital guys they'd put some initial stuff in, but they were busy trying to get out and sell to capital markets, and so and you're talking tens and hundreds of billions of dollars, in that venture capital market and the private equity market. Whereas now there's billions out there. And so the hard part is it's just not as visible. So as we're looking through this, there's a reasonable amount of guesstimates in terms of saying, well, during the tech boom, I could see a lot of this stuff. I could see you could go and look at the annual reports of the people who were reporting, here's your new customers and all that. Whereas when you've got these unlisted new customers, it is way, way harder to get the whole film of what's going on and where this finishes. So so net effect of all that hopefully is that you sort of got a better idea now of what is this data center boom going on? Who are the people benefiting from it? So I think that 5 sort of tiers of about thinking builders, people who are providing the energy to it and cooling systems, the technology and sort of hardware, people who are providing the actual equipment within that. At the moment, that's where most of the value is, and most of the intellectual property, whereas these other ones is just a scarcity thing. Then you got your sort of operators of these, the people actually running these data centers. And again, mixture here of scarcity and there's a genuine business if you're good at doing these at scale, but there is certainly a scarcity element within those and within all levels, but they're very profitable still. And then the AI architects, at the end that are the ones that are the least profitable. And when those AI architects, we start seeing more and more of that money that going back to the others is just these guys recycling capital. That's when we get most concerned. But until we see that, I still think there's scope for this to get bigger. It's one thing, you can come back to that original chart that we had in terms of sorry, let me just bring that back up. In terms of the hype cycle. Where you talk about where you are in that cycle, and if we're only halfway up the this boom cycle, then there's certainly room for this to grow. You might be past where you're going to finish up. You pass your productivity, and the question now is, as an investor, do you want to sit out of this and just say, oh look, it's going to rise a lot more. I'm going to sit out of this and I'll come back even if it goes for another couple of years, and I'll just come back in a few years' time and buy when they're lower, or do you try and you try and invest as you go along? And I think for us, the issue is, especially given how fast moving it is, we just don't know how high the peak's going to be, and so things are starting to look a little weird with some of these figures, but they're not at the sort of really crazy figures you see in other ones. It does look like Trump's busy trying to get lower interest rates, and there's a bit of weak capex elsewhere. It could just be, opening up for a similar type of boom to what we saw during the tech sector. So yes, that's where we're sitting. Some of the companies we like, and some of the ones we have in our portfolio. And I'm going to talk more about some of these other companies involved in the whole build out in coming weeks. Thanks for listening in. We're on every Thursday, usually at 12:30. Apologies for a different time today, and then the extra delay due to a fire evacuation. But there was we're on there. You can get us on various different podcast channels, all the majors and most of the minors as well. We're on YouTube. Feel free to drop in any comments and any thoughts around those if you've got any questions. And look forward to seeing everyone next week. Thanks.